5% of the Nifty weightage, which was underperforming. Reliance, HDFC Bank, ICICI Bank, along with IDC. 0.5% lower. We were not anticipating anything different. In fact, adjusted for the GIFT Nifty implied open, it seems like it's going to see some more red. 0.5%, just about defending the 2300 mark for Reliance Industries. One of the key culprits in the market weakness of late. Even the Nifty actually is just about defending the 19,400 print, so it's getting pretty brittle out there. Let's see what HDFC Bank is up to. Another 1% of a crack coming in there. It's up the 1,500 mark, 1,495 now for HDFC Bank as we speak. ICICI Bank, ITC, that will just come up for you on your screens next. ICICI Bank slips to 934 levels. ITC is down about almost 0.5% as we speak. Now let's talk about Bajaj Finance, Avenue Supermart, IDFC First, and then let's revisit the likes of a Bank of Maharashtra as well. Bajaj Finance is still managing to hold its head above water in an otherwise weak market. 2% of a move coming in for Avenue Supermarts. That's climbed up above the 3,800 level. 1.5% lower for IDFC First Bank, which has launched its 3,000 crore rupee QIP. Bank of Maharashtra, ITC of course is lower. Bank of Maharashtra, the gross advances have seen a decent uptick on a year-on-year basis as part of the takeaways of the quarterly update. A 2% uptick coming in for Bank of Maharashtra as we speak. And then Mahindra Finance as well, wherein the disbursements were lower than what the market was anticipating. There's a note from Morgan Stanley as well this morning on this one. That starts off about 2% lower as we speak right now. So bunch of stocks there which are on our radars. Let's also revisit what the new listing from yesterday, JSW Infra, is up to, given that it closed well above its opening price, which was a 20% premium to its issue price. From there, you're seeing another 5% of a move coming in on JSW Infra. There's of course RVNL too, which has emerged as one of the lowest bidders for the HP State Electricity Board's project, which is worth about 445 odd crore rupees. So look out for that. There's Titega Rail as well, which has bagged a project worth about 857 odd crore rupees. This is from the Gujarat Metro Rail Corporation. That's going to be another stock which is in focus. And then I want to definitely check in what Vedanta is up to. This has been quite the newsy stock. Big uptick on Friday. Monday as well, that stock held out. And right now, it's down about almost 1%.
Well, yes, and the one which is actually seeing quite a bit of cut today is the auto space. Pull up the Nifty Auto Index. That's the worst performing index. It's M&M, which is down over 1%. Bharat Forge, Motherson Sumi as well. Of course, there was the North America Class 8 truck orders that had come in. Didn't look very impressive, and that's the reason you're seeing a slide on some of these names. But overall, it is a weak opening, and the advanced decline ratio are favoring the declines. No surprise there. It's only FMCG, which is the sector which is holding up in the green, and that too mildly so on account of Nestle, which is now up almost 4%. But let's take the first trades from our chartists as well. Naresh, what's the first trade you're punching in?
Like SBI closer to this mark of 595, 598, structurally setting up for a breakout, so that could be a trade for the short term.
That's a buy coming in. Kunal, what about you?
So D-Mart is something which looks attractive, and I think at 3700, 3750 mark, something which I would look to buy.
All right, that's the view coming in from our chartists about the individual stocks that they're looking at. Time to connect with Pankaj Tibrewal as well, find out his outlook on the markets as well as the way ahead. Pankaj, good to have you. And the question is, with the sort of negative undertone that we're seeing across on Wall Street with the rising bond yields, etc., do you believe that that poses a major threat for our own markets, or do you think that we're going to continue to hold out and these are just mere bumps along the way?
Good morning. I think in the near term, there are headwinds both from global and local, economic data which are emerging. Globally, clearly, we have seen 10-year bond yield inch up to 4.8. Crude is at $95, no longer at $75. And clearly, the commentary coming out from Fed is that rates may remain higher for longer. So clearly, that may pose headwinds for equity markets, globally speaking. In India also, there's a dichotomy which is going on currently at the ground level. Consumption on one hand seems to be on the weaker side, especially the lower end of the pyramid. And clearly the volume growth of many companies in the first quarter also in consumer staples suggested that. Also, if you look at some of the other parameters like Savings bank growth in FY23, it was flattish. Personal income tax growth in the first 4 months seems to be at around 4 to 5%. Whereas on the other side, when you look at B2B businesses, whether it be cement demand, whether it be power demand, they continue to be very strong. Order inflows continue to be extremely strong. So there's a dichotomy at the ground level between consumption and B2B businesses. Our sense is that consumption to around the second half of this year should start picking up, led by festive season as well as election spending. And don't forget that this time, the wedding dates in the second half are about 35, 36 days, which is one of the highest over the last 4-5 years. So I think broadly speaking, in the near term, markets may face headwinds. However, if you take a 3 to 5 year view, I think India is very, very nicely positioned from an economic cycle perspective.
Right. Pankaj, what one has seen is that despite the bit of an aberration that the small and mid caps did face, and, that too in just various concentrated, overheated pockets within the mid and small caps, when the market did come off from that all-time peak, earlier last month, the broader market has been a lot more resilient, and it surprised many on the street as well. Do you think this outperformance of mid and small caps vis-a-vis large caps is here to stay for some more time?
So in the near term, we are cautious on mid and small caps, and there are many data points suggesting that one should carefully navigate this space in the near term. And let's look at 4-5 data points which have helped us across cycles spot the excesses on both the sides. The first is the market cap distribution and profit distribution. So if you look at the market cap distribution today, large cap, which is the top 100 companies, have come down to about 65-66%. And mid and small caps are now about 34-35%. And especially in that, small cap is about 16-17%. But when you look at their profit distribution, the top 100 companies constitute about 75% of overall profit of India Inc. And mid and small caps constitute about 25%. So there is a disconnect between the market cap distribution and the profit distribution right now. The second is, if you look at the earnings yield, which is nothing but 1 by P, the earnings yield of large, mid, small, micro are virtually the same, which means that the valuations have converged significantly. Generally, we have seen over the last 2 decades that there's a discount which normally happens because they tend to be more volatile than the large caps. But this time, the earnings yield of large, mid, small are virtually the same, hardly any discount, which suggests that we are nearing the greed zone on mid, small, micro. The third, if you look at, is that we track something called greed and fear indicator. The greed and fear indicator suggests that today everybody wants to own mid, small, micro, and nobody wants to own large caps. Our sense is that the same was repeated in 2017. Though today it's a lesser extent, but 2018-19, we saw the broader markets correcting, but Nifty was held on where it was. Can we see a similar repeat to a lesser extent this time around? Possibilities, yes, because the divergence between the performance of broader market and Nifty has been significantly higher this time around in the first 6-7 months. And there are pockets in mid and small caps which are overheated as we speak. So one needs to, closely watch it out. Last but not the least, if you look at the Google trends, you will see significant amount of interest in small caps, names, small cap companies, small cap funds. And mind you that the flow in the small cap space over the last 6-7 months has been significant. If you look at the data, more than 28 to 30,000 crores of inflow into the small cap funds. Free float has not increased that much. So a lot of money chasing little stocks probably, and now market participants navigating from higher quality to lower quality. This is something we need to be a little worried about, and hence our cautious stance on mid and small caps in the near term. But if you take a 3-5 year view, I think this space is always exciting. There are bottom-up opportunities. And as we speak, we believe it will be a more of a stock pickers market rather than painting the entire sector with the same brush.
Pankaj, I wonder where you stand when it comes to the entire IT space, because of late the street is also getting a little bit negative, saying that there is no convincing signs of a pickup in tech spends, as well as the fact that the demand trends continue to look rather mixed. So what is your stance on IT?
So whatever channel checks we have done, the demand continues to be a little weaker. And our sense is that the US recessionary trends probably will weigh on IT spends as you move ahead. However, the good news is that the wage hike probably is behind us. In the last 3 quarters, if you look at most of the large IT companies have seen net de-escalation in employee count. And this we have not seen for a long time. So probably demand supply is not against the IT companies, so margins will be protected. But demand continues to be softer unless we see significant pickup in order wins in 2025, fiscal year 25. But probably in the next couple of quarters, demand is expected to be weak, which will weigh on the valuations of most of the larger IT companies as we speak.
Oh, well, yes, and a lot is weighing on the market because the Nifty is below 19,400. ICICI Bank, Reliance, Axis Bank, NTPC, these are the big culprits which are dragging the markets even below the mark of that 19,400, which we had seen last in the month of September thereabouts. But Pankaj, what about the entire discretionary space? Because of late we had seen that pickup happening in terms of, whether it's a QSR, whether it's tourism, whether it's autos, etc. Do you think that will slow down, or do you think that is likely to continue?
I think barring near term where there could be ups and downs, I think India is in a very sweet spot as you look at the per capita income. We are at $2,400, and over this decade probably will move above $5,000. And this is a time where really the J curve kicks in, and many sectors in consumer discretionary would see a very significant pickup. We believe that you have to look consumption in three parts, divide India into three parts. India 1, which is about 15-20 crore people. India 2, which is another 20-25 crore people, and India 3, which is the remaining, which is the daily wages, the rural people, and so on and so forth. I think you have to position yourself in discretionary in India 1 and India 2, because that's where the aspirations are moving, and that's where the real consumption is happening. So we look consumption with a slightly different lens as far as discretionary is concerned. Many sectors appeal on that. And I said at the start of the conversation that second half we believe discretionary spend should pick up, led by 35, 36 wedding dates, led by election spend, both at the center, at the state level, and led by festive season, which is pushed on to the third quarter this time around. So many franchises which have consolidated over the last 2-3 years, valuations have moderated. Probably our bias towards them will be positive as we speak from a 3-year, 5-year perspective. And we would look to own some of those names as you move ahead.
Quite interesting. Pankaj, where within that lies your tilt within the large caps?
So large caps, I think if you look at the BFSI space, the private sector banks, they have, I think, meaningfully corrected on valuations, and time correction has happened. I think that pocket looks to be reasonably valued. Again, coming to autos, I think being a cyclical sector, that sector also is reasonably poised. The third is the infra space, and on the large cap, there are not many names, but whatever few names are there on the infra space, that sector looks to be reasonably valued. And tactically, we have to play the IT sector. Whenever we see that the earnings downgrade cycle is behind us, probably IT sector would start also look to be good. And sorry, I forgot on the pharma. I think pharma sector incrementally, I've been saying for the last 6 months, we continue to be positive. First quarter, we saw that after a long time, the entire pharma cohort reported 22 to 24% earnings growth. We believe the trend should continue in this quarter also, led by decent US traction. Our channel check suggests that US price erosion has been much lower than what we have seen in the last 4-5 years. And many Indian players incrementally should benefit at least in the near term, from the from the lower price erosion which we have talked about. So I think pharma incrementally is also looking quite okay.
That's quite nice, Pankaj. Great to have you on the show today. Thanks as always for taking the time out.
Thank you. Thank you.
Okay, let's just revisit what the market is up to because it's getting pretty rough out there. We're down, by the way, 150 points. We've even broken that 19,400 print for the first time since I think early September there. 19,392 is where the Nifty is right now. HDFC Bank down 0.5%, Reliance down 1%, and Axis Bank is one of your biggest drags right now. Okay, I stand corrected there. HDFC Bank is actually in recovery mode. Axis, of course, is down about 2.5%. But I think there's a bit of an aberration because HDFC Bank futures are still trailing by about 0.5% or so. And Reliance, of course, is the other one which is significantly under pressure as we speak. All sectors are bleeding, led by power and metals. Bajaj Finserv, Bajaj Auto, Coal India, Apollo Hospitals, Adani Ports. These are all stocks which are languishing as we speak right now. But here's Safir Anand telling us what he's liking in this market.
Well, I have been buying some of the PSUs, ex-banks, for example, where there is a substantial start of a capex cycle and the companies are sitting on very huge order flows. And their historical problems have been more to do with non-recovery of money because it does not seem to me, and at the risk of being wrong, that's what market is. It does not appear to me that there will be non-recoveries of dues. And that is perhaps one of the reasons why companies, for example, in the power sector in PSUs have done exceptionally well. There are very large capex plays in some of the other PSUs, which are more engineering companies, etc. So when you feel that you have to sort of eliminate the risk of downside. If you've eliminated the risk of downside, then even if you go wrong, you don't pay a very heavy price. And therefore, some of these companies appear to be doing the right things right now by bagging those orders and not overbidding in terms of literally zero margins in order to bag those orders. In fact, some of the companies are refusing new orders in order to protect their margins or to increase their margins.
On the show, I get a message immediately, ask Safir about the next stock idea. How am I supposed to respond to it? It's your choice. I'm asking questions somebody's asking me on digital media.
No, see, like I said, I've named the sectors that I'm invested in, and you are all aware that I'm not a SEBI registered advisor, therefore it's only my personal portfolio. But I have looked at adding some of the banks. I've been buying Jammu and Kashmir Bank from a price of almost 30 rupees, but I've also added it last at about 75 odd rupees. Recently, I've added Punjab National Bank because I do believe that things are going in the right direction there. There's always the risk of market corrections, and therefore there is a margin of safety, and I do not complete my buying at one particular day. I do have no hesitation in sort of averaging up if I believe that the story is doing well. I'm also doing a little bit of risk on my portfolio, which I do not advise your viewers to do, but until and unless the diligence is absolutely complete. For example, I have bought, I would call them as a medium risk to medium risk buys, which have a very sort of doubtful past when it came to the way they manage their finances. One is a company called Suzlon, where I've bought the stock at maybe 17 or 18 rupees, very close to the QIP price. And the second one, where I'm reading more of the legal developments than the market developments, is Coffee Day. Because it appears to me, at least optically from the court readings, that there is a settlement that is going on. Most of the people on the lending side are sort of withdrawing their complaints, and if the current management is able to walk the talk, then it's only an 800 or 850 crore market cap company in a very good sector if they're able to revive. The problem is if they don't revive and managements, for example, are concealing certain things to do with debt and all, then I'll have to pay the price of it, and therefore my risk profile will be managed by not an overexposure of any kind.
The other one I wanted to discuss was Zomato. I mean, I know you bought in at 40, but you have added up in the run-up to 100 plus levels on that stock specifically?
No, I'm not added and I'm not sold, and therefore I'm pretty happy with what is happening there. In fact, the management is walking the talk to some extent, and I would rather give it more time. In fact, I was privy to one of the shows that you all of you did, and you were talking about the impact that Zomato may face because of World Cup and the exuberance in terms of, ordering because people will be glued to the television. So I'm also benefiting a little bit from the advice that you have sprinkled on top of my dish to wait and see how it performs.
Oh, you're going for the World Cup matches all the way to Ahmedabad. I'm sure you're not sitting on TV and watching them.
No, well, I will not be going for all of them. I may go for some of them, but yes, some of it I will watch on television also because, sometimes there is too much of crowd and things of that sort. And sometimes, you may not get the requisite number of people to go with you because your friends are busy in some other thing or that sort. But yes, there is fun of watching the matches definitely live, and I equally enjoy watching on the larger screen at home.
That's the take coming in from Safir Anand. Let's just quickly revisit what the index is up to. Down about 0.7% as we speak. By the way, the mid-cap index as well is feeling the heat because you can see a cut of about 1% or so. This, remember, after the kind of weak handover that we had from Wall Street, and blame it on the PSEs, blame it on auto, energy, metals, as well as the Nifty bank index, because everything is buckling under pressure. And within the broader universe as well, there's a whole host of stocks that are down and out in trade. M&M Fin, JSW Energy, TVS Motor, Oberoi Realty, Manappuram Finance are just some of the cases in point. All right, let's talk about all the action in the primary markets then, because there's been nothing short of an IPO rush on D Street. We've got with us Mr. S. Ramesh, is the MD and CEO at Kotak Mahindra Capital Company, to discuss this and more. Thanks so much for taking time out, because it's not just the IPO rush, but the fact that off late we've seen a lot of promoter blocks as well taking place. I just wanted to get in your overall take on the same. Are you seeing a trend of that picking up now or waning off? And how do you believe the street should be reading into that, the promoter blocks?
So, first of all, let me start by saying that in general, India Inc. and the financial sponsors are pretty active in the supermarket of deal making of all types, debt, equity, and M&A. You specifically asked about sell down by promoters. I would say that in general, sell down by the financial sponsors have been quite active in the last 12 to 18 months. But when it comes to promoters, I think it's more concentrated. Maybe these promoters have had reasons of deleveraging or other reasons why. But as a trend, we don't see in recent times, or as we gaze into the future, any specific action around promoter sell downs in specific.
Okay, fair enough. I also wanted to get in your take then on the fact that we've seen a lot of action returning into the IPO markets. There's been a plethora of IPOs day after day practically. What do you believe that this is indicative of? And do you think that this is likely to be a trend that will last perhaps till the end of the year, or is only likely to pick up?
So let me warn you, I'm going to give you a little long-winded answer, but maybe I'll start with the preamble that we are witnessing a pretty active primary market. But having said that, I would say that we are witnessing the syndrome of rising tides raise all boats. So we are actually seeing old pipeline which could not get successfully done earlier, etc., getting cleared in recent times. So this is one characteristic. Second characteristic, which is a little unusual, is it's been dominated by the industrial sector as opposed to healthcare or financials of the past. Third, the average sizes of these IPOs, which you have seen in the last few months have been quite small compared to what we saw in calendar 21 and 22. That's understandable, because if you were to just rewind back to 22, we didn't see a very active primary market. So I don't think issuers will, by and large, getting prepared to file prospectuses for a launch in 23. And therefore, you have only seen 3 offerings or 4 offerings of larger size. But I think there's more to come. And I think the general exuberance that you will see in a primary market, I expect it to get better after elections of next year. And the other thing that we are witnessing is there are some very good conversations going around on listing of new age tech companies, which I think you'll see a very active window post the elections. And the other good thing about this run in primary markets is most IPOs have listed well, which is good for investors. And we should wait and watch how sustainable they are. I do think that totally there is close to an $8 billion of pipeline, both SEBI cleared and which are filed. And I expect the market to be good, not exuberant, but more dominated by smaller deals, with the exception of a few large deals that may hit the market. But after elections, one should expect to see a more robust primary market.
As one is already. But Ramesh, I mean, not just main board IPOs, but SME IPOs as well are picking up, right? Even as SEBI is putting SME companies in ASM, which may not impact the IPOs. What's your take here?
See, I would confess that we don't track the SME platform. So maybe I'll skip this. I don't think I'm on top of what's happening in this segment.
Not a problem. But what is your reading of the overall M&A landscape? Because that also has been seeing some heightened activity. So wanted to understand which sectors do you think that activity is going to only get upped when it comes to M&A at large?
So I think India is in the middle of pretty active deal making in the M&A space. A lot of India Inc. and large private financial sponsors are very active. If you saw the last few months, you actually saw deals announced in Route Mobile. You saw Bupa's acquisition in Niva Bupa. You saw Bearings getting pretty active in HDFC Credila. You saw the announcement on the Glenmark deal by Nirma. So it's very active deal making. 2-3 trends which are very heartening to see. We are starting to see green shoots in some sectors of the re-emergence of the strategic investor, which was missing for some time post the COVID. The second thing is we are continuing to see domestic companies, dominating the acquisition space, and financial sponsors are really on the prowl. They have capital. They're looking for doing deals. So around the themes of deleveraging, either generation change, a better allocation of capital, and all these reasons, we're actually witnessing a pretty strong M&A environment. And we expect deal making to continue. And you must sharply contrast this to what's happening to other parts of the world.
Right. The other thing I also wanted to talk about, Ramesh, was the overall landscape for capital markets right now. Of course, with news of the bond inclusion, etc., one is likely to see more flows. But there are a lot of events as well which could have a binary implication, as one of the brokerages rightly said this morning, for the capital markets. You've got all the policy action coming in. We've seen what's happening with the US bond yields as well. And then, of course, the big one which is impending, which is the elections.
So I'll divide the answer into two parts. I'll make a statement or two about general markets, what are markets focused or concerned about. I think when you talk about India, you cannot escape the topic of expensive valuations. In general, investors find that valuations are expensive. Small cap, mid cap, they start to get expensive every time. So this is on the back of growth and expanding margins. But one is expensive valuations. Secondly, I would just put a small caution around geopolitical and oil particularly for the short term to medium term. And hopefully we'll see better correction. And when it comes to primary markets, and you talked about markets, because I'll just like to leave a line for the retail investors in specific. The Indian primary markets is largely predicated on a fantastic regulatory environment and institutional support, right? You always have themes where institutions tend to drive pricing of IPOs. They decide which IPOs are good. So I think as long as that architecture continues, by and large, we will see a reasonably healthy, accident-free primary markets. And I expect that to continue. But I would request the retail investors not to get carried away, because they are making returns today. They have to be careful and choosy. As they see a large number of IPOs come to the market, they have to select their bets carefully.
It's been interesting. Thanks so much for joining in and giving us some insights into the promoter blocks, the IPO markets, as well as what you're looking at the overall environment there. All right, with news that we're at 19,397, take a very quick break, but be right back. We've got lots more lined up.
It is the perfect bachelor pad.
तो कब लगा आपको?
अरे पहले बैचलर तो बन जाने दीजिए। डिवोर्स की फाइल घूम रही है कोर्ट में।
मतलब अभी नहीं खरीदना है?
अरे अभी खरीद लिया तो ये घर भी उस फाइल में अटैच हो जाएगा। समझ रहे हैं ना आप?
इसलिए housing.com का हाउसिंग असिस्ट फॉर रेडी प्राइस मैच एंड वेरीफाइड बायर्स. housing.com. पोस्ट योर प्रॉपर्टी नाउ.
Welcome back. Well, the market is still below 19,400 at least as far as the index is concerned. And if you look at the individual, constituents, most of the sectors are actually in the red. It's only FMCG which is doing well, and that too because of Nestle, HUL. Because other than that, Tata Consumers, Warren Beverages are all on the back foot, and a lot of these auto companies are also on the back foot. Madison Sumi, M&M, TVS Motors, Bajaj Auto, they're all coming under pressure. Yesterday as well, we saw that despite a decent number coming in as far as the September print is concerned of auto sales, some of these stocks were actually declining. What's the reason of that? Is Street penciling in a bit of a weakness? Let's discuss that with Mr. Vinod Agrawal, the MD and CEO at VECV, joining us on the show. Hi Vinod, good to have you on ET Now. Well, you've crossed the mark of 7,000 units in monthly sales after the month of March, and that has supported the sales number this time around. But going forward, what's the momentum like? Because we are hearing that a lot of inventory buildup is there in the system right now.
I think the commercial vehicle industry for last 2 months specifically has been doing extremely well. Last month was very strong. In fact, the total sales for 3.5 ton and above for the industry are at 47,000, and it has grown by 18%. So therefore, going forward, I think Q4 traditionally is good because of the festive season and again the year end, and then Q4 is also expected to be good for the industry because of the year end. Therefore, we are expecting a good year for the commercial vehicle industry.
Okay, Mr. Agarwal, what about the outlook when it comes to steel prices as well? Because that of late has been on the rise. So is that going to impact margins in any way, and how much?
I don't think we are expecting a major change in the steel prices as of now. So let's see. I don't think that's a concern at this point of time.
So having said that, then just the kind of margins that you've already clocked in, they look sustainable?
Yes, margins, if you look at, we had around close to 8% margin in Q1 and EBITDA margins. Therefore, if the volumes are better in H2, then we should get some operating leverage benefit.
Sure, Vinod, I wanted a bit more sense. When you say that this year is going to be good, next couple of quarters are looking strong, especially Q4 on account of the year end, etc. What kind of volume growth are we penciling in for the entire year? Is it going to be high single digits? There's a strong possibility of double-digit growth as well.
It is going to be somewhere around double digit, because first half we have the industry growth of 7%, even though we have grown by around 12% VCV. So we are already in double-digit growth. Industry is at 7% for 3.5 ton and above. Now, if you look at the last 6 months, Q1 was not so good. Q2 was much stronger than the Q1. So both put together, the growth is 7%. So we are expecting Q3 and Q4 should be better than the first half. Therefore, the growth will be there for the overall CV industry, maybe around double digit. Since it is 7% in the first half, so there is some recovery happening in the second half, then it can reach closer to double digit or slightly more than double digit.
So does that mean that you are also growing faster than the industry in the sense that you are gaining market share? Because if I have it right, in the LMD segment, your market share in Q1 was close to 37%. What does it stand now?
Our 6 months market share for LMD is 33.8%. And it is much better than last year. Similarly, in heavy duty trucks also, both Eicher and Volvo trucks put together, our market share is now at 8.8% in first 6 months. So we are closer to 9% in the heavy duty trucks. And in buses, our market share is 22% for 6 months. So therefore, market shares we are doing better since we are doing overall better than the industry. So we have improved in the market shares.
Sorry,
the only concern in the market is the exports. Exports are continuing to fall very badly. In fact, last month also the exports were extremely down. They were just exports out of the country only at around 1,500 units. So now we are down to 1,500 units a month per month last month. And average is around close to 2,000 units a month. Whereas At peak, it used to be around 5 or 6,000 units a month. So it is down from 5 to 6,000 to just around 2,000 a month. And so that's a bit of concern that is pulling down the overall industry growth as well. But other than that, if you look at the heavy duty trucks are growing, YTD growth is 16%. Buses are growing very well. Buses, the growth is 37%. And light and medium duty trucks, there is little bit of flatness. It is little bit drop, in fact, because last year there was good sales of CNG trucks in the first half. And this year, the CNG trucks are not as strong as it used to be last year first half. So therefore, LMD industry is a little bit down. But both HD as well as buses, they are having very strong growth. But exports are down and LMD is a little bit down. So that's why the overall growth is looking at only 7%.
Well, I actually have two follow-ups on that. A, in terms of exports, when do you see the recovery happening? Because it's down to 1,500, 2,000 units per month. When do you see it go back to at least 3,000, 4,000, if not 5,000, 6,000? And the second question, you said that your LMD first half market share is 33% thereabouts. If I have it right, in Q1, it was 37%. So is there a loss in market share? Do I have that right?
No, it's not. Month to month, it is not possible because traditionally, if you look at last year, our market share was 31%. So from last year, overall, we have grown by almost 2.5%. It is 33.8. So therefore, it is a growth. But first half, there may be different reasons for a month, specific month. We may having higher market share, but doesn't mean a loss of market share.
Exports, recovery?
Sorry?
On exports, what's the recovery timeline you have in mind?
Exports, we are optimistic because now this, if you look at this trend in the South Asian markets, they have been going through this pain for quite some time now. And I'm sure there will be recovering in those markets because end of the day, the markets, their economy has to come back. It is not that they will continue to remain under recession like this. And of course, India is also trying to have rupee trade with some of these countries. And if that rupee trade gets activated, I think that will also help. So let's hope that the exports will start recovering soon. But as of now, the situation is not so good.
Export recovery hopefully should start soon. I just wanted to also get an insight from you in terms of what the outlook is on crude oil prices, which internationally as well have been on the rise. What about the impact in terms of profitability? Is there going to be any short-term impact, do you reckon?
I don't think it will have short-term impact. Overall, if you look at the fuel prices are quite all right in India. They are continuing to be stable. There are ups and downs in the crude prices, but as you know, there doesn't look to be a concern for the economy as a whole. We are expecting good growth in the economy, and overall, we are expecting that Indian economy will do well. And if economy does well, then of course the CV industry will continue to do well.
Mr. Agarwal, how big an opportunity do you see in the EV space? Because the government is coming up with a lot of these tenders. In which ones are you participating, if at all? What kind of order inflow are you expecting specifically from the EV segment in commercial vehicles?
EV segment, of course, we are expecting the tenders to come up soon. I think the government is working on resolving this issue of payment security mechanism as soon as they are on top of it, and then they will, I think, release the tenders. And of course, depending on the robustness of this payment security mechanism, I'm sure we will participate in all the tenders because we have the products. We are already selling electric buses on the capex model in some of the states, and we are also selling these electric buses to some of the private customers. So therefore, as far as the electric buses are concerned, of course, they have got a very good future. As far as the government buying is concerned, I'm sure this new announcement of Prime Minister E-Seva bus plan, they are going to buy 10,000 buses. I think that's a very good plan, and I'm sure this payment security mechanism will get resolved. And when the tender comes, we will participate in that.
Okay, Mr. Agarwal, on that note, we'll let you go. Appreciate you making time for ET now. So that's the word coming in, expecting at least a double-digit growth by the end of the year. But the stock which is seeing quite a bit of recovery at this moment is HDFC Bank. We should pull up the intraday chart of that one because for last many days, that one was actually languishing in the red. At least for now, it's seen a pickup from the bottom of the day, and all of that because the update that we have got for Q2 looks quite strong. Harsh is joining us to run us through those numbers. Harsh, your analysis?
Well, yes, right off the bat, good solid update coming in from HDFC Bank. You're seeing 5+% sequential uptake on both the combined balance sheet with regard to advances as well as deposits. First off, we'll focus on, there are several numbers as part of the announcement, but we'll focus on ex-HDFC Limited's non-individual loan book. In terms of overall advances, except this particular piece of the loan book has grown 5.5%. 23.3 lakh crore is where that number has come in terms of the cumulative advances. Even in terms of deposits, very healthy uptick, 5.3% with regard to deposits on a sequential basis that we are seeing. Again, this includes the HDFC Limited deposit book as well. So on a combined book level, you are seeing very healthy growth. In terms of the year-on-year numbers as well, you are seeing 17.6% growth on the advances front, 18.2% growth on the deposits front. What within advances is showing solid growth? Well, your CRB segment, which is commercial and rural banking, has grown 30% on a year-on-year basis, 10% uptick sequentially seen there. And the other piece that is also in focus is with regard to corporate book. Your corporate wholesale book has seen growth now, 6% sequential uptick on the corporate book, 8% year-on-year. So all of that 8% year-on-year growth is back-ended. Clearly, you're seeing a good set of numbers coming in from HDFC Bank.
Right, thanks very much for giving us that roundup. Tell you what, we'll slip into a very quick break. Stay with us. On the other side, Vijay Kedia will be joining in a short while.
Welcome back. Well, the market is showing no signs of recovery, even if HDFC Bank is actually perking up. Nifty continues to languish in the red. In terms of stock-specific action, it's MTAR Technologies, which has seen a bit of a spike. Mahanagar Gas, after that 7-8% run yesterday, continues the up move today as well. That stock is high by around 3%. You also have Adani Wilmar, which is doing quite well. And JSW Infrastructure, as we pointed out earlier, continues to gain after that the momentum that we saw yesterday when it listed with a gain of almost 30%. IOB is the other banking name apart from Bank of Maharashtra, which is doing okay. The stock from the financial space which is coming under pressure is M&M Financial. The disbursement at 4,500 crores, which we got just towards the end of the trading session yesterday, was a bit lower than what at least Morgan Stanley was expecting. And for the quarter as well, the company has fallen short of disbursement expectation, and there's a bit of a chink in armor when it comes to the asset quality as well, and the street is not liking that. That stock is down by almost 4.5%. There's a cut on Manappuram Finance as well as Max Healthcare as well. Just wanted to address the flashes for you on the bottom of the screen, wherein it suggests that Bloomberg might be looking at considering addition of India FAR bonds into the index inclusion as well. Of course, we'll have to look for more details in terms of what index this is going to be and what will be the extent of the inclusion in terms of which bonds will be eligible or not. But nonetheless, an important news flow coming in from that as well. But shifting focus back to the markets, because Gautam Shah has turned a bit cautious on the markets right now. He's saying that it is a bit of risk-off mode which is underway, and that's why it's better to be in sectors like IT, pharma and auto. Listen in.
20,200 was definitely a short-term top, which might not be taken out in a hurry. The market, given the way it's corrected in the last 10 days, has just validated that view, and the evidence that has come up on the charts hasn't looked good. In fact, we've been maintaining a cautious stance for the last 7-8 days, and we continue to do so. I think from a Dow theory perspective, we still need a break below 19,500, which I think is just a formality. And if and when it happens, the market has the potential to lose another 4 to 5%, at least, if not more. So I think things have changed quite a bit in the last 4 or 5 months. Whenever there has been a correction, we've always said buy the dip, be a buyer, because I think the market will go on and make new highs. But this time we have not maintaining that stance. So our stance has changed quite a bit in these last 10 days.
So for those who are watching the show and for those who will watch it on digital, should they now be locking some gains if your advice is that the market, the path of least resistance is on the downside? Is it time to at least book 25% profits?
Absolutely, 25% or more. I think in all the stocks and sectors that have run up substantially in the last 4 to 5 months, I think one should take profit. And one should realize that suddenly you have just too many headwinds. I mean, look at global markets. They've corrected quite a bit. Look at US markets, European markets, Asian markets. Look at what Hang Seng has done today. So many world markets have actually seen a large correction in the last 10 days. That's not look good. We are getting closer to the assembly elections. We are getting closer to the general elections. Oil has been quite a headwind, and FI money hasn't been as strong as it used to be. And let's not forget the big underperformance of Reliance and SDFC Bank. Two of the stocks where if you really compare it with the Nifty, you'll see that they are at 52-week lows on a relative basis. So these are not factors that are very positive, and I think the momentum will pick up on the downside below 19.5.
All right. What's the stance then, Gautam, when it comes to these stocks that have really powered up, the likes of the railway stocks, the defense stocks, which really boomed? Do you believe that, you need to be very selective when it comes to this space? Or now do you believe that the positive time or the party is really over?
I think the party is either over or close to getting over for most of these stocks and sectors. A lot of the basis was on the Excel sheet over the next 5 to 10 years. But, when trends turn abruptly, it happens really, really fast. And I think a lot of these stocks went through a parabolic move in the recent past. So I think railway and defense clearly are spaces where one should take profits. And, we are focusing on stocks which have quality institutional interest, because let's agree to the fact that there is still a lot of liquidity in the system. And domestic liquidity is coming into the mid caps and small caps. So fund managers in the mid cap, small cap space have a lot of money to actually commit in their own stocks. So I think what we are focusing on right now is committing into stocks with quality institutional interest, quality fundamentals, great structural stories, which I don't think will be impacted if the markets were to correct. But on a general basis, on an overall basis, mid caps and small caps, one should be aggressively booking profits here.
What could be the duration of the decline? Could it be a multi-month decline? Could it be just a bad patch which happens in a bull market, swift, sharp, before you realize correction has started, it actually is over?
It doesn't look of that variety, Nikunj. You and I have seen markets over a couple of decades, and every time this market tries to do something new. In the last 5 months, it was always a quick decline, so that bias is there in our minds that this time also something similar will happen. But when I look at the leadership, I clearly see it missing. We released our big picture report, a 47-page report yesterday describing the long-term trends. And if I were to just go by that, I feel that this could be a multi-week, maybe even a multi-month kind of a consolidation stroke corrective phase. So broadly, in terms of numbers, I think if we are able to stay in that 18,900, 20,400 kind of a band, and stay till Diwali, I think we would have done very well for ourselves. But I do believe at some point of time, we could test 18,900 and possibly even 18,400, 500.
Not of the view that we could see a pre-budget or a pre-election rally, because that has always happened.
Well, things change, times change. In fact, a lot of smart money have been putting this question that should we actually take on the assembly election results? And I think a lot of people want to get cautious before that. So I don't think you're going to have any sort of pre-budget or pre-election rally. I don't think this time it's pretty much different. And let's not forget, we still live in a synchronized world. Till a month back, world markets were all positive or range bound. Then the Dow is now close to a multi-month low. The S&P 500 has stopped outperforming. The Russell 2000 in the US is actually near a 52-week low, despite all that we talk about the US markets. And European markets and Asian markets don't look good. So in a challenging global environment, global equities environment, and with oil continuing to rise, and I do believe NYMEX crude will move towards 104, given all of these factors, it doesn't seem as if the market will see a bump up very quickly.
Okay, so there was a cautious view coming in on the market, but are there any chart busters idea that our charters are picking at this point of time? Naresh, any stock specific recommendation?
So looking at the index, which could be very important going forward, that is S&P 500. So what we've seen over the last few weeks has been the correction in the US markets. S&P 500 from 4,500, 4,550 has corrected down to 4,225 and has broken the recent low. So that's the first indication of a short-term trend shift which has happened here. But on the say oversold charts, the stock is getting the index is getting into oversold zones. So the RSI is below 30. The last 3 times it was around this 30 mark was back in September of last year, as well as the whole of multiple times when it went to 30 RSI, we've seen a decent enough bounce. So in this case, the last breakout point is 4150 to 4200. Cluster of supports around that 4100, 4200 band, as well as oversold nature. So from that 4100, 4200, which could be reached today over there, could be a bounce back back to 4350 to 4400 levels on the S&P 500 going forward. So that would create some bit of a short-term reversal even in Indian indices from this 19,200, 400 band.
Kunal, curious to understand what's the chart buster that you've tracked?
So, Asha, it's on D-Mart or Avenue Supermarts, and how the stock over the last few weeks is starting to show signs of a potential turnaround. So, this is the charts for D-Mart on the short-term time scale. This red line is the 200 moving average on the daily charts for D-Mart, and stock over the last few weeks, specifically from the March lows, started to show signs of a bottom formation closer to the 3200 levels. This was the higher low pattern the stock has been making consecutively, and then in this last 2 or 3 months, specifically in the last couple of weeks, the stock had broken past above its 200 moving average, gone up higher, took a retest of this 200 DMA, and now seeing a bounce, which means potentially the stock is heading towards a breakout of this swing pattern first, and the second swing resistance, which is around the 4,100 levels for D-Mart. So looks very attractive as a setup. And my sense is that looking at the recent bounce and the shape up of this 200 DMA as well as the higher low pattern for the stock, it should break past about the 4,100 levels and possibly over the very near term should come back to this zone of 4,300 to 4,500 levels for D-Mart.
Okay, let's talk stocks as well. Kunal, what have you identified?
So I've looked at a couple of buy calls over here on the short-term basis, and the first call which I'm suggesting for short-term traders is on Bank of Baroda. Would suggest a buy with a target of 224, stop loss at 212. Ramco Cement is the stock which is also given a breakout about that 940 level, so would suggest a buy, 988 as a target, stop loss 922.
Right, Nilesh, what about the stocks that you've picked out?
So first is the buy on SBI, a good risk reward trade here, stop loss at 585, target price of 640. Second is a buy on EIH Limited, a retest of the last breakout done. The hotel sector looks interesting at current levels. We are seeing a bounce back and breakout in a lot of names. Stop loss at 225, target price of 270.
We're going to take a very quick break with news that there's been a breach of that 19,400 print, and we haven't seen any material improvement from there, still languishing sub the 19,400 mark. Axis, Reliance Industries, these are your two key pressure points for the Nifty today. Even within the broader end of the market, there are a few stocks which are bleeding and weighing heavy on the broader markets as well. Look at M&M Finance. That's now, by the way, down almost 6% as we speak. IDFC First is down 3.5%. There you go, M&M Finance, 4.5% of a downtick coming in. On futures, it's almost scaling a 6% decline. IDFC First is down 2.5% right now. And then, of course, there's NTPC as well. There's PNB, which is also seeing that bit of correction. And a whole host of other names from within the broad markets which are weighing heavy. We'll take a very quick break. When we come back, a very special interaction with none other than Vijay Kedia on the other side.